Hello, this episode is analyzing and recording transactions. Welcome. In the previous episodes, we had looked at accounting content, financial statements, financial reporting and preparation, and ethics in accounting in the previous episodes. This episode today we'll be looking at analyzing transactions. The learning objectives include to explain the accounting cycle, describe meanings of account and ledger, define debits and credits and double entry, describe a chart of accounts and its relationship to the ledger, analyze transactions on accounts, record transactions in a journal and post entries to a ledger, and prepare and explain the use of a trial balance. So let's go. The accounting cycle. Cycle, as the name denotes, that's starting a process from a point and it completes at another point. So the accounting cycle takes note of the procedural transactions take from the analysis of it till posting of the final accounts. So the first is to analyze transactions. You to analyze it, post entries, prepare unadjusted trial balance, adjust the trial balance so that you have adjusted trial balance. After the trial balance has been adjusted, you can then proceed to preparing financial statements. The trial balance has to be adjusted before you prepare the final statements. For emphasis, if the trial balance is not adjusted, let's say you want to prepare the trial balance from the unadjusted, prepare the financial statements from the unadjusted trial balance, the risk is that your the financial statements will not balance. For instance, the balance sheet may have some things that will make it not show the true and fair reflection of the business position, financial position. So you must adjust the trial balance, then prepare the adjusted trial balance so that you can prepare the final accounts. Then you close the accounts, then you post the prepare the post closing trial balance. This is the accounting cycle. Once transactions happen in the business accounting year, all those transactions would be recorded. You remember, as we said in an episode, that one key difference between record keeping and accounting is that record keeping mainly details daily transactions and puts it in record. Daily financial transactions are recorded. Accounting has record keeping and other functions like analysis, classification, interpretation, preparation, and communication of financial statements. So once there is transaction, or once there are the collection of transactions, you analyze the transactions till preparation of post-closing trial balance, when you are able to prepare your financial statements. In the very previous episode, the very last episode where we talked about the content of financial statements, we looked at the cash flow statement, financial position, the income statement, and the statement of changes in equity. So these are the statements that will be prepared after the trial balance has been adjusted and ready. The account is a detailed record of increases and decreases in a specific asset, liability, or equity item. Asset is equal to liabilities plus equity. Assets are resources owned by a business or owed to a business. That is the definition of asset. They have economic value. They are resources with economic values and are owned by the business or owed to the business, like cash, account receivable, supplies, property, plant and equipment, as PPE, and prepaid salaries expense. Prepaid expense is also an asset. Then we have the liabilities. Liabilities is account payable, notes payable, loans, mortgages, all amounts of funds or all debts or indebtedness or obligation of business to third party. Any amount that is being owed by a business is a liability. Then equity is capital, is reduced by withdrawals. Then service revenue will increase net income, and net income would increase capital or equity. Withdrawals would reduce it. The T accounts, from the letter T, as the letter looks, T, like a table here. So it distinguishes two sides of account, left and right. So T accounts record transactions in recording transactions in T accounts, according to the rules of debit and credit. So when we mention T, we're looking at the left hand side and the right hand side, the two accounts of a business. So they are represented by letter T, which uses T to record increases and decreases of business transactions. Establish an account for each individual asset, liability, capital, withdrawal, revenue, and expense. So the left side is the debit and the right hand side is the credit. So if you draw your T, letter T, as a table, the left hand side is the debit side, the right hand side is called the credit side in accounting. Debit record all of the money flowing into an account, while credit records all of the money flowing out of an account. Basically, receive with left, give out with right. Left is debit, it receives. Right hand side is giving. Right hand side is giving, left hand side is receiving. Just like a relay when athletes are exchanging battings. So the person giving it out in the first leg, for instance, that's sprinting. So and that's similar to a relay race. One person that is finishing a leg will exchange, will give out, and next person will receive it with the other hand. So in accounting, one person gives, one entry gives, the other receives. The entry that gives is the credit. The entry that receives is the debit. General ledger. This is group of accounts that records data from business transactions. So general ledger groups accounts as they occur. So we have the capital, accounts payable, cash, and revenue. Now let's look at this example of a general journal where entries are originally recorded, and this process is called journalizing. Remember, in the stages of accounting cycle, after the transactions have been recorded, they have to be journalized. So this is one example of how an account has been journalized. It shows how you put entries in the debit and credit. Now, example 1, or on January 1 here, cash was brought into the business by the owner, or the owner started a business with $10,000. So that means the business is receiving fund from the owner. Owner is treated as a separate entity from the business. Business is a separate business entity. In one of the previous episodes, we talked about that. The first episode on accounting in business. The episode, you may search for it, accounting in business. That one talks about this process in an elaborate manner already. So now the owner gives cash to the business. The episode I'm referring to is the episode that talked about is titled Accounting in Business, and he talked about forms of business organizations and their characteristics. Business entities are for businesses that are existing for accounting purposes, but legal entity is for incorporated businesses only. So business entities means a business that is existing must establish itself as a business person. It must record its accounts, it must separate its affairs from that of the owner. So when the owner gives to the business, the owner is called capital, and the cash of the business comes in. So cash is debited, the owner Vic line is credited. Credit is the right hand side, debit is the left hand side. Both must be equal at every given point in time, because the amount that is given by one entry is the same that is received by another entry. Supplies and cash. If you look at this point, supplies is debited, which means supplies is received, cash is given out. This is a transaction that shows that there was payment for supplies. So supplies were bought in cash, purchased store supplies for cash. So cash goes out, cash is given out at the point of purchase, and supplies are received. Supplies come in, so supplies will be debited, cash is credited. On the same January 1, the third entry to journalize: supplies and equipment. Supplies, equipment, then accounts payable, note payable. Look at this very much. This shows that there is a liability. These are the people that give, or entries in quote that give. That means there is a supplier that gave 1,100 item, and that's supply. That means a supplier gave or issued out 1,100 and has not been paid yet. That's why it's called accounts payable. Supplies were received, that's why it is in the debit side. Equipment was received, but it is credited to note payable, which means you are owing this individual or organization rather that gave out this amount, this item. So note payable is given out. This is the entry that gave out, and it's called note payable because, or when it's called note payable, it means it's a promissory of payment. It has not yet been paid. If it was paid, assuming it was paid, instead of note payable, this would be cash, because cash would go out, equipment would come in. But in this case, equipment comes in, cash has not gone out, but it is the way it is being owed. It is an obligation to the organization that gave it out, that sold it. So that's why it's credited. And since it's not yet paid, it's not payable. Note is more like promissory that you have to settle. Accounts payable are suppliers that you have to settle. Both are the ones that give in this transaction, and this is a good example of journalizing entries. This is a journal, and these examples studied here are examples of transactions and how to journalize those transactions. Posting journal entries. General journal information is transferred to the general ledger, which means from journal, the amount you have here in this journal would be transferred to the general ledger, and account balances are updated. For instance, cash of the business was possibly a certain amount before, but now it has increased here by 10,000. Cash was spent here by 2.5. That means as of this point there is 7,000 net cash in. 10,000 was in, 2,500 500 was spent out. Then there was no cash here. So that means whatever the amount of cash as at 31st December 2013, this is 2014, that means any amount of cash as at 31st December 2013 would be adjusted at the end of this journal. Assuming there was $50,000 cash at the end of 2013, December 31. That means at the end of this day, this date, January 1, at the end of this date after this journal, cash would increase to 57,500. It was 50,000, but this is net of 75. That's 50,000 plus 10,000 minus 2,500. That gives us 57,500 balance of cash. That means cash accounts is updated. And this process is called posting. That's the process that we call posting. That's the process of transferring journal balances to the ledger, the general ledger accounts, and you update the balances as just been explained. That is a process that is called posting. While posting, we open the respective accounts. This is a cash account. Let me scroll up a bit to backtrack. This journal has cash on January 1 and capital 10,000, 10,000. 10,000 in the debit of cash, 10,000 in debit credit of capital. So we will open cash account and capital account separately or respectively. So 10,000 will be in the debit side of cash and 10,000 would be in the credit side of capital. So look at it. This is cash account. So the balance was not known before, so assuming January 1 was the beginning of the existence of the business and there was no previous cash, so 10,000 is debit. That means total balance is $10,000. General ledger 1, this is G1, is coming from this general coming from this principal account, principal reference is coming from here. Now capital account is credited. We can see it's credited. So we open Virgil Climb capital account, credit it, and it's coming from that same journal G1, and 10,000 balance at the end of that transaction that you have posted and you have balanced or updated. Finally, for this episode, general ledger T account. T account looks like the general ledger account and is used for learning purposes. T account. Now, Brenda Clark capital account. This is debit side, this is credit, and this is balance. So look at this capital account. Explanation lies the detail, date, explanation, debit amount. In that case, there was no the capital account was credited, so and we credit it here. The same thing would be done if it cash account that we are entering. Basically, this account will be called cash account. January 1 or whichever the date it happened, then the journal it is coming from as detailed, general ledger, then the amount could be in the debit or credit depending on what happened. If the entry had received, it would be in the debit side. If the entry had given out, if it's an entry given out, then the entry would be in the credit side. So whatever the balance you had before, you increase it. or you decrease it, as the case may be. Capital account is in the credit side. So if anything happens next that affects the debit side of capital, for instance, if there is withdrawal would be in the debit side, and it would reduce the amount of capital balance. So this is what we do, and this is what we mean by posting. At this point, we'll round off this episode, and if there is any question that you possibly have or anything else you want me to highlight, kindly put in the comment section. It will be responded to accordingly. Thank you very much, and do have a great time.